Multifamily syndication. If you're just getting started learning about real estate investing, syndication can seem a little confusing, but it doesn't have to be. In this video, I'm going to walk you through three things. What is a syndication? Why use a syndication structure, and who can participate in a syndication? So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about real estate investing 101, multifamily syndication. The first thing I want to cover is what is a syndication. And if we look at the dictionary will tell us a syndication is a pooling of resources. And in the real estate world, it's a pooling of capital, of money. So what happens is we have all these individuals out here, and they could be business owners, lawyers, accountants, doctors, programmers, other high-income individuals. And they have capital, they have money they want to invest. And most people out there know all the benefits that come with investing in real estate, so they want to acquire some real estate. They may not have the time, they may not have the experience, they may not have the network necessary to take down a deal on their own. Or maybe they only have enough money, enough capital to allow them to buy a small deal, and you don't get all the benefits of scaling when you're only acquiring small deals. So what happens is all these investors can pool their resources together in a syndication and go out and acquire a much larger deal, and all the benefits that come with scaling up. You have the economies of scale, you have improved cash flow, you have full-time management, you have better debt terms. I could go on, the list goes on forever. We have all of these investors pooling their capital, but who has the experience, who has the track record, who has the team, who's going to take this capital and put it to work? This is why we have two parts to a syndication. We have a GP and we have the LPs. The LPs, or limited partners, are the capital investors. These people are passive investors. They are only bringing their capital into the mix, and this capital is going to be invested, is going to be put to work in a real estate deal by the general partners. The general partners are people who have the real estate experience, they have the track record, they know the markets, they're sourcing the deal, they're finding the deal, underwriting the deal, walking the deal, negotiating the deal, managing the property, managing the project, and then deciding when the best time is to sell to realize maximum returns for the investors. So like I said, we have two parts. The GPs, these are the people running the deal. These are the active people in the deal. And then you have the limited partners. These are the passive investors who are bringing their capital, pooling it together in a syndication to take down a much larger real estate deal. The second question is, why use a syndication structure? And the answer is pretty simple. Wall Street does one thing really, really well, and that is they raise a large amount of money. And they use the syndication structure to raise this large amount of money. So in a real estate application, if you're buying a large property with scale, so a large multifamily or apartment building complex, you need to raise a lot of money. And the syndication structure is built to do that. That is the syndication's purpose, is to raise large amounts of capital from passive investors. And this is another reason why to use a syndication structure. If you're going out and partnering with one person, so you'll actively manage the deal and the other person is bringing their money, you are both considered active participants. It doesn't matter what happens, you're both on the hook. In a syndication structure, the limited partners are afforded protections under the law because they are limited partners. They are the passive investors. Sure, they're risking their capital like they would in any other investment, but the general partners are shouldering the risk in that venture because they are on the hook in case the deal goes south. So syndication structure, why? It's made to raise large amounts of capital. So if you're raising a lot of money for a real estate deal, use the structure it's built for. Second, the investors bring their capital to the deal are true passive investors. They can focus on doing what they do best day to day, which is running their law practice, being the best surgeon in the area, running their business really well, maybe leading the way in terms of programming or whatever it is they do best. They can concentrate on putting bread on the table and earning their high income while somebody with the real estate experience can take their capital and put it to work. The other thing that syndication does really well is customization. You can really customize and tailor the structure of the syndication through shares and voting rights and levels of shares to really suit your project. Syndication is a beautiful vehicle for raising large amounts of capital from passive investors and applying it to a specific real estate project. And that leads us to the third question: who can participate in a real estate syndication? Generally speaking, when it comes to real estate, a syndicator, a person, a general partner who is creating the syndication will be looking to work with accredited investors in terms of bringing capital into the deal. Now, who is an accredited investor? There are a couple different thresholds. Number one, you can meet the threshold through your income. So you can earn $200,000 a year as your income. Second, if you're a couple, you can meet the threshold of $300,000 a year combined income as a couple. Or you can have assets of $1 million or more, not including your primary residence. You can't count your house if that's your primary residence, but you can count the net equity in your, if you already have a real estate investing portfolio, you may have some stocks, bonds, other investments. This certainly counts. So who is an accredited investor? You can have $200,000 a year as your personal income, as a couple $300,000 a year, or you can have $1 million of assets, not including your primary residence. And generally speaking, these accredited investors will make up the majority of capital coming into a syndication. Now we know what a syndication is, why we use a syndication structure in real estate, and who can participate in a syndication. So that must be leaving you asking, well, how do I participate in a syndication? It starts by having conversations with people syndicating real estate deals. So you can head on over to callseth.com and set up a free 20-minute phone call with me, and we can talk about your real estate goals, your real estate plans, and what you're looking to do when it comes to your real estate investing. I hope you liked this video and you found this useful, and if you did, leave a comment, let me know what you think, hit the like button, it really helps out, and until next time, happy investing.